Hello and welcome back to the channel. Today, we're diving deep into the Q1 2025 earnings report from Crocs Incorporated, and let me tell you, it's one of the more dynamic results we've seen this season. Despite macroeconomic volatility, increasing trade tensions, and consumer uncertainty, Crocs has delivered better than expected results, while also navigating some serious headwinds that every investor needs to watch closely. Let's break it all down by financial performance at a glance. Crocs brand overview. The power of marketing and collabs. HeyDude brand update. Supply chain and tariff risks. Operational strength and financial position. Final thoughts, outlook without guidance. Crocs reported total revenue of $937 million, up 1% year-over-year on a constant currency basis. This beat their internal guidance, which had anticipated a revenue decline of about 1.5%. Gross margin came in at 57.8%, up 180 basis points compared to last year. This was driven by lower product costs and a favorable customer mix, especially on the Crocs brand side. Operating margin was reported at 23.8%, which was over 200 basis points higher than their prior guidance. Most notably, adjusted diluted earnings per share held steady at $3, again beating the high end of expectations and staying flat versus last year. That's a powerful outcome, especially considering the environment Crocs is operating in. The Crocs brand alone generated $762 million in revenue, marking a 4% increase year-over-year. The international segment was the real hero here, up 12%, with China growing over 30% and Western Europe also showing solid results, especially in France and Germany. North America was down 3%, but still came in ahead of plan. In terms of product performance, the classic clog remains a staple. But growth is now being driven by expanded silhouettes like the Echo and InMotion franchises, as well as elevated styles like platforms and hiked clogs that are trending well, particularly in Asia. Crocs is also continuing to push into new wearing occasions with strong momentum in sandals. Getaway, Brooklyn, and Miami styles outperformed and now represent a significant growth avenue, particularly exciting, as 54% of sandal buyers were new to the brand. Crocs continues to win with digitally led, social-first marketing. Their limited edition Bape collaboration generated a massive waitlist and led to 70% new customer acquisition. They also hosted a spring break activation with influencer Alex Cooper, and that alone garnered over 2.5 million social impressions in a single weekend. On TikTok Shop, Crocs ranked as the #1 footwear brand, showing that the brand is thriving not just in stores or on websites, but directly within social commerce ecosystems. In China, they relaunched the Bei platform clog in partnership with celebrity Tan Jianxi, TJC, which saw very strong digital engagement and in-store traffic. This kind of culture-driven momentum keeps Crocs highly relevant, especially with Gen Z and younger millennials. Now let's talk about HeyDude, which continues to be in a brand reset phase. Revenue for HeyDude in Q1 came in at $176 million, down 10% from last year. But there's nuance here. The DTC channel grew 8%, reflecting early traction from their digital initiatives. The wholesale segment declined 17%, primarily due to a strategic reset of their Wally Stretch sock program. This was expected, and the good news is, the new updated product line is being well received by retailers. HeyDude's marketing game has also leveled up. They ran a viral TikTok Shop Super Brand Day, where HeyDude ranked as the #1 footwear brand. Their Sydney Sweeney x Austin Lift campaign reached 8 million consumers, and they had massive presence at the Houston Rodeo, earning the title of Grand Champion for Best Brand Experience. On product, HeyDude continues to evolve core styles like Wendy and Wally, and even launched 2 new collabs with Jelly Roll that sold out quickly online. In short, the HeyDude brand may be down in revenue, but it's stabilizing, and perhaps poised for growth later this year. Here's where things get complicated. Since February, the U.S. government has rolled out incremental tariffs affecting many of the country's Crocs sources from Because of this, Crocs made the bold decision to withdraw their full-year 2025 guidance. Here's the breakdown. 47% of Crocs' U.S. sourcing comes from Vietnam. 17% from Indonesia. 13% each from China and India. 5% each from Mexico and Cambodia. If a 10% incremental tariff is applied across all sourcing, Crocs estimates a $45 million impact on an annualized basis. But if the 145% China tariff remains on top of that 10% global baseline, the cost could balloon to $130 million annually. The company emphasized they are proactively shifting sourcing, controlling inventory, and analyzing selective price increases as part of their mitigation strategy. Despite global uncertainty, Crocs' balance sheet is solid. Inventory is stable at $391 million, in line with last year. Net leverage remains within their 1.0x, 1.5x target range. The company has $166 million in cash and $679 million in available credit. And during Q1, they repurchased $61 million in stock, with $1.3 billion remaining in their buyback authorization. Free cash flow remains strong, and management has clearly signaled that they're focused on long-term value creation, not just short-term volatility. So what does all this mean? Crocs is demonstrating that it can grow revenue, expand margins, and drive brand heat even during volatile times. They're transparent about the risks, agile with their sourcing, and bold in how they engage with the consumer. HeyDude is not yet back to growth, but its foundation looks stronger than ever. And the decision to withdraw guidance? That's not a weakness, it's a sign of discipline in an uncertain macro environment. So now the question is, what do you think? Is Crocs still a buy in 2025? Or are tariff risks and consumer softness enough to make you cautious? Drop your thoughts in the comments. And don't forget to like, subscribe, and hit the bell icon if you found this breakdown helpful. I've got more earnings analysis and market updates coming your way every week. Thanks for watching, and I'll see you in the next one.